Hello everyone and welcome to another training video. In today's video, we're going to be talking about market structure. Now, this is very, very important. Understanding market structure is key if you're going to be good or at technical analysis because it's basically the foundation. Okay, so let's jump straight into it. And here's what we'll be running through. What is market structure, the types of market structure, and then we'll look at some example with each of those different types. Now, market structure is basically simple and the basic, how do I put it now? It's just simple how the market moves, right? Understanding market structure is basically simply understanding how price moves. Now, it is basic support and resistance level on the chart. Don't worry if you don't understand what support and resistance and stuff like that is, you would understand soon enough. It's just about how price moves. Now, you understand how water moves, water flows, right? Ball rolls, right? Grasshopper hops. So that's how each of these different things move. How does price move? And what are the different scenarios? What are the different areas or areas, where how price could move? So think about it this way. It's how do we move as humans? Well, we walk, but sometimes we run, and sometimes we can jump or climb. So these are different movement or even crawl, right? Now, it's understanding the different structures of the market is quite important so that you can figure out exactly what particular nature is the market and what is the best, what will give you the best probability to find profitable opportunities. Because remember, anytime we approach the market, anytime we look to take a trade, we are only looking to do one of two things. We're either looking to buy or to sell. And whatever we choose, price can only do one of two things, can either go up or come down. Now, when we buy, we are anticipating price to go up or appreciate. And when we sell, we're anticipating price to go down or depreciate because those are when we make money either buying or selling. So, but we want to figure out what is the trend because what you notice, somebody who is in a good form is most likely to take football, for example. If a striker is in hot form, right, and is scoring goals, he's most likely going to score more goals because he's in, the trend is that he's in hot form, right? Similarly, a striker who's having who is struggling maybe because of mental issues or, he's struggling just because of poor form. Well, every chance seems to be, even if it's open goal, it feels like, the striker can't take the opportunity, but a striker who is in hot form, even when it seems quite impossible or, it's unlikely, we still take those chances and score those goals. So in the same way, understanding the trend would help us figure out what to do and how to follow the market. What are the best opportunities to look for in the market? So this is basically what market structure is about. Now, market structure is often referred to as price action, right? We refer to this study as market structure because it's how the whole market moves. Understand the trend and anticipate the moves, and then we can add other criteria like, support and demand, other blocks, volume, pivots, moving average, indicators, whatever it is you want to add. The first point is to understand what are the different phases in the markets. And then once we understand the phases, what should we be looking for in each of those phases? And then we can ask, okay, how do we confirm? Because just because the market is going up doesn't mean every place is a good place to buy, right? You would want to figure out, okay, yeah, price is going up and is most likely going to want to keep going up. But what are the best places or what are the possible best places where if I buy, it will give me, I'll buy with minimum risk and high potential reward. Okay, so this is where the other qualifiers or confirmations like SND, other blocks, whatever comes into place that you'd use. But market structure is the key. Now, the market tends to trend in three different directions at any given time. Now, and understanding when a shift occurs based on the time frame, obviously, you're looking at is important, is pivotal to success in trading. Now, the three different types of market structure is one, the bullish market structure, which is sometimes called an uptrend, the bearish market structure, which is called a downtrend, and the sideways market structure where the price is not really moving up or down, just moving within a range, which is sometimes called a ranging market. Now, traders can take any time frame to analyze the market. So you can, depending on what you prefer, you can look at the market at any given time frame, make out a niche for yourself. And just because the market is bullish on a daily time frame doesn't mean it can be bearish on a 5-minute time frame or even a 1-hour time frame, right? Because a daily time frame, a daily candle is a combination of lots of 5-minute charts, right? It's a daily time frame is a combination of 24 candles. So, even though price might appreciate within the day, from the opening of the day to the closing of the day, price might have gone up. But sometimes within the day, there would have been times where price appeared to be bearish or ranging or bullish again, right? But overall, it's ended up going up. So this is what I mean when I say that structure would differ between time frames. Okay. Now, market trends in one of three of the above directions. So it can be an uptrend, a downtrend, or the sideways trend, or a ranging market, basically. So the market is always in one of these stages. The market is always trending one way or the other. It's either bullish, it's either bearish, or it's ranging, right? Now, the majority of the time, the market is trending sideways, right? And then you have this outbursts from those ranges in either direction, up or down. So actually, ranges, when the market begins to range, usually tends to signify opportunity one way or the other. Is now how to confirm this movement, because price could spike up one way and eventually go the other way. But understanding these three different areas, and sometimes on a bigger time frame, a ranging market might be an absolute beautiful trade to take, because each of the range bound might give us very nice opportunity. Now let's begin by looking at the bullish market structure or the uptrend. So the bullish market structure, so let me just take this out. Now, the bullish market structure, a bullish trend is depicted by higher highs and higher lows. So when price is going up, bullish, right, means that price is making higher highs and higher lows. Now, the trend would most likely continue in that direction until price begins to make lower lows and lower highs, right? So what it means is, if the market is bullish, we can anticipate that price would most likely stay bullish. With that in mind, in a bullish market or a bullish market structure, we would be better off looking for buying opportunity, because therefore the probability is that price will continue to go up. So if a striker is in hot form and scoring goals for fun, well, if they are playing your team next, you'll be scared, because, well, they are, their momentum, they have momentum, and most likely they will score goals, more often than they would miss, because their confidence level is high. So the same thing with trend. The market tends to respect the trend. And there's a saying, the trend is your friend until it's broken. That means when the market is trending one way, you're better off looking for opportunities to continue that same way. Okay. So for example, let's look at this. This is what an uptrend looks like when price is printing higher highs and higher low. You can see low to high, and then made another low, right? So you can see this low here is, so let me draw. So you can see that this low here is higher than this low down here. And then this high here is higher than this high here. So in an uptrend, price tends to make higher highs and higher lows and higher highs and higher lows, right? So when we see the market making higher highs and higher lows, what we want to do is start looking for opportunities to continue buying. Now, most times, many traders, when they see the market going up, they start looking for opportunities to sell. And this is why a lot of people make losses, right? What you want to do is figure out a way to continue the overall trend, look for opportunities to continue the overall trend. This is where something like counter trend trading, counter trend lines, price action, candlestick setups, S&D, all that blocks comes into place, where you start looking for what are potential areas where price could continue the overall trend from, support and demand and all. Now, here's an example of an uptrend. So you can see that, well, price, like I mentioned earlier in this previous video, price doesn't move in a straight line, right? When price wants to move, it doesn't just move in a straight line. It moves in wave-like or zigzag pattern. Now, you can see, obviously, in drawings, it will look like plain, very straight. In real life, it doesn't look exactly as fine, but you can see the resultant effects. You can see that price is resultantly moving upward. But how is it doing it? Well, start from this down price here, this low price here. It makes a low, forms a high, makes a higher low, and then a higher high, higher low, higher high, higher low, higher high. So you can see price just keeps resultantly making higher lows and higher highs and higher lows and higher highs. And we can expect the price to continue to do this until price begins to make lower lows and lower highs. Right? So this is the reason why I say understand the structure of the market. So imagine if price was here at this particular point here, what will you be looking to do? Well, because the overall structure before now, you could see higher lows, higher highs, higher lows, higher highs, is bullish, then there's a good chance price will most likely want to stay bullish. So we want to keep looking for opportunities to buy low. So this is where the concept of buying low comes into place, right? The market is trending higher. We look for low prices to buy because the overall momentum of the price is bullish, right? Now, the next type of market structure is the bearish market structure or the downtrend. Now, a bearish trend or a downtrend is the price action, the way it shows on the chart is you would see price resultantly making lower lows and lower highs, right? Now, similar to like what I mentioned about the uptrend is when the market is bearish, it's most likely going to continue staying bearish. Therefore, you're better off looking for selling opportunity in a bearish market because that is the side of momentum. If a striker is out of form, right? If a striker is in poor form and is, has not scored in over a year, well, chances are they will not score in the next match because, well, first of all, their confidence level is low, the momentum is against them. And actually, the momentum of not scoring is actually in their favor. So this is how trend works. It works everywhere. You can apply the same thing in everything, right? So if the market is trending lower, well, there's a good chance it will continue in that trend. Now, it's not a guarantee, but there's a good chance. And remember, what we're doing here is we're playing the probability game, right? So therefore, in a bearish market or in a downtrend, we want to look for high prices to sell. We want to look for opportunities to sell. And a bearish market will look something like this, where you see price making lower lows and lower high. You can see that this high is lower than the previous high, and this low is lower than the previous low. So a bearish market makes lower lows, lower highs, lower lows, lower highs, lower lows. That's how we identify a bearish market. So when you open your chart and you see the market making lower lows and lower highs, you're looking at the bearish market. So first thing is you start looking for, okay, where are the opportunities for me to sell, right? So you're looking at the most immediate structure, the most immediate price structure leading up to current price, and then you start looking for opportunities based on that trend. And here's an example of what the bearish markets will look like. This is the price for Euro USD, the daily time frame. And you notice here that, well, over time, this is for over a year, about a year, price has been making, you can see from this high, actually from much higher, but let's just take from this high here, price made a low, made a high, right? Then made a lower low and a lower high, and keeps making lower lows, lower highs, lower lows, lower highs, lower lows, right? So in a bearish scenario like this, what do we want to look for? Well, we want to look for opportunities to sell because, well, that's the direction that's the part of least resistance. Price tends to flow in the part of least resistance. That means when the market is bearish, it's easier for it to continue going down. And when the market is bullish, it's easier for it to continue rising. So if you see the structure in the market and it's bullish, well, you want to look for bullish opportunities. And if it's bearish, you want to look for bearish opportunity. And then something to note is you want to do this based on the time frame you are looking at. Now, just because this market is bearish on a daily chart doesn't mean you open your 1 minute chart and then every single area is a good opportunity to sell, because, well, on that particular structure or that particular time frame, it might not be both bearish, it might be bullish. For example, this period here where price goes up like this on a 1 hour chart might look very bullish, and on a 1 hour time frame might actually make sense for you to look for buying opportunities based on the structure price is presenting itself, right? Now, one of the key things to note is when the market has posted the structure, it's most likely going to respect it. And then for the market to respect a bearish structure, it means that price it should be making lower highs. Therefore, this is where, where we start to come into, how we manage our risk and all of those things. Where do we keep our stop loss? So if price is bearish, you would most likely not expect price to come and take out previous high. We're not going to expect price to make new higher highs. Instead, we want price to make new lower lows. So if we're looking to, for example, price came from this high to this low, and then we look to sell, our stop loss would be above this high because we don't expect price to come back and make a new higher high. Every of this high is expected to hold. That means the closer price is to the previous high, the better opportunity that price could present, that the market could present for us to continue in the overall trend. Don't worry, when we start looking at some trade systems, it will make more sense, right? Now, besides the uptrend and the downtrend, there's also the ranging market. Now, the sideways trend or the ranging market is a situation where the price is really struggling to decide, right? You find this a lot in the market, where actually in smaller time frames and in even bigger time frames, sometimes where price is really struggling to make its mark, to move, to pick a direction. Now, in this kind of market, it's usually called a consolidation period, where neither buyers nor sellers are in control, and the market is just, buyers and sellers are fighting for who would take the next run, right? And a ranging market is identified where price is making equal highs and equal lows. Now, don't take all of these things as what I mean is equal highs and equal lows doesn't mean it has to be exactly equal highs and exactly equal lows. And what you're looking at is resultantly, you can see that price is not really moving fast, just going up, coming down. It's not making higher highs and higher lows, or lower lows and lower highs. It's make higher highs, come back, make lower low. But within the same range period, price is not moving very much. So here's an example of the euro against the New Zealand. This is a daily time frame. You can see that this is spanning over several months, right? Within this area drawn out here, you could see price really didn't go far, right? Eventually, it picked the direction. The price really didn't, go far. It would go up, come down, staying within this range. So this is an example of a ranging market. And what followed that? Well, at some point, the thing about ranging markets is the market doesn't like to stay in ranges. At some point, it would break out. And you could see we had a fake out, and then we had the actual breakout and the continuation of that leg lower, right? So this is an example of a ranging market. And here is, all of them put together. The market is always moving from one trend to another. So you could see the market is on an uptrend, making higher highs and higher lows, went into a downtrend, making lower lows and lower highs, then went to a sideways trend, and then went to a big uptrend and a downtrend. So you find this severally in the market, where price is going from one trend to another, sometimes from uptrend to downtrend, or sometimes from uptrend to sideways trend, or downtrend to sideways trend, or downtrend to uptrend. But figuring out the actual trend you are will now say, okay, if the market is in an uptrend, then I want to be looking for buying opportunity. If it's in a downtrend, I want to be looking for selling opportunity. And if it's in a sideways trend, I either want to wait and allow the market to decide, or maybe try and treat the range, okay? So this is where we come to the end of this particular training video, where we look at market structure. So at this point, you have some sort of in-depth knowledge about structures in the market, how the market moves, what you should be looking for, what are the different types of trends, and what opportunities should you be looking for in each of those trends. We'll take it a step further in the next video, and we'll start putting the pieces together. Hope you enjoyed the training. I'll see you in the next one.